to just go ahead and drive on. All right, so we are in bearish normal conditions, so we are not going to favor swing trading in that period of time. We would be very judicious about deciding to hold it overnight and over the weekend. The next section, we're looking at the 5 different look-back periods and computing the tortoise NDX for that, the scale of 0 to 100. And as I briefed earlier this week, on the 3-day look back, the S&P is at minus 57. So that one indicates that Friday's price action broke down significantly out of the 3-day look back period. We're in the middle of neutral on the 10-day. On a monthly basis, we're still in the strong overbought over the last 30 days. And then we are about back to the midpoint in the 90-day and the 270-day look back period. So that kind of gives us a placing of where we are, where the market is in that longer term frame. Okay. The most important one for me when I'm looking at the week ahead is really where we are in that 10-day, because the 10-day look back is my default timing on market and price location for that market for the week ahead for swing trading. And since swing trading is the central perspective for me, then that's why I default to the 10-day. Okay. Still waiting for it to finish uploading. Oh. Okay, next we're going to look at the market mosaic to the right-hand side. So price with respect to the 200-day moving average is still bearish. It's 5.74% below the 200-day moving average. So that keeps it, it's 3.74% below the boundary to sideways. So sideways is defined as plus or minus 2% around the 200-day moving average. So that puts us in bearish. The fact that that value is red means it's among the worst readings in the last 180 days. So it gives you also a sense of just how bad it is within context. The ADX is neutral at 20.8, so it's non-trending right now. The ATR is 2.48%, and compared to the last 100 days, that's actually normal volatility. Now, 6 months ago, that would have been extremely noisy. Oh, thank you for reminding me, whoever. All right, microphone check. Let's try it now. Okay. I'm on a different internet connection. All right. Good evening, guys. Ken at Tortoise Capital. This is the weekend trading plan for May 2nd, 2020. Market classification, bearish normal. So we favor short-term trading and favor a bird in the hand worth over a bird over 2 in the bush, right? Looking at the NDX over the 5 look-back periods, we see the 3-day look back, price broke down on Friday significantly below where it was the previous 3 days. The 10-day is in the middle of neutral. 30-day is still strong, overbought at plus 87, and the longer term 90 and 270 are both in the middle of neutral. Price relative to the 200-day moving average is red bearish at minus 5.74%, meaning we're almost 4% below the boundary to sideways. So we're still in a bear, although it's improved quite a bit. The ADX reading at 20.8 is neutral, so there's no real strong trend in either direction. The ATR percentage over the last 100 days compared to the last 180 days is 2.48% in the range of normal, and that means that volatility has calmed down in the last week or so. And what's interesting to note on this is that 2.48% ATR percentage 6 months ago would have been almost triple the daily volatility. And so 2.48 would have been extraordinarily volatile. Trying it again. How are we doing now? Testing mic. Mic check. Okay. So the 2.48% ATR percentage is normal for right now compared to the last 180 days or last 100 days. But 6 months ago, that would have been like triple times the normal volatility. So the truth changes based on local context. And so this mathematical treatment allows us to protect against our own recency bias. The risk Z at 1.229 is when we compute the 30-period moving average of the VIX by the 10-period and express that as that ratio. Anything greater than 1 favors risk on, by which we mean you can hold riskier assets and take a shot at swing trading. Anything less than 1, it goes to risk off, and then shorter term trading and more conservative assets are favored. So that is pointing towards a favorable swing trading. We compare that to the last 5,000 trading days, and we come up with a risk Z score of 2.08, meaning it's 2 standard deviations stronger, or actually in this case less volatile than the 180-day average. And here you can see a time series of that. And you read this the same way that we read the MACD histogram, that you see winter, spring, summer when it goes above the 0 line, and then when it rolls over, it's in the fall. So anytime you get the volatility index, that Z-score, rolling over more than 1 standard deviation away from 0, then that quite often represents a turning point. So this decline in the risk Z here is an early warning to us that this period of favorable volatility decline may be coming to an end. And so we are on the lookout for sharper one-day adverse moves. In this case, that would be sharp sell-offs. And in the last 2 days, we've actually seen that. A quiet selling on Thursday and then a sharper selling on Friday. So now the opening salvos on Monday will be of great interest to us. Okay. So that's how we use this, the risk Z, to help us appreciate the effect of volatility on our holdings. It's time for the blended monthly rebalancing portfolio. This is what we were holding in April. It was mostly treasuries and it was all treasuries and mostly cash. And now for May, what is indicated is 1/3 treasuries. Then if you're using the ETF 13, the 2 leading candidates are the Qs and SPY. If you're looking at ETF 22, where we add the XL series, it would be tech and healthcare. That seems reasonable. And then if you add some of the other global ETFs, it turns out treasuries, gold, and short-term bonds are favored. The leading candidates in these equity portfolios, the Dow 30, the sectors, and the ETF 200, you can see right here, that's dominated by Microsoft, Walmart, and then the healthcare sectors of United Health, Johnson & Johnson, and Pfizer. So that's a way that you can kind of rapidly pick out some of that longer-term relative strength that we care about. That comes from the strength rating that we get from the ETF2 model. The ETF2 model's theoretical exposure is still just 10%. So it is not recovered enough in either time or distance to really justify. Well, I haven't changed the screen. I'm still talking about the first page. So the theoretical exposure in ETF2 is still 10%. All right, so moving ahead now, page 2. Still trying to get the those reports uploaded. I'm going to see if the new internet connection is going to let me do that. Bear with me. right, so this is the monthly market health check, and all we're doing here is we've moved out away from the day. I'm going to go to my second backup connection. I wonder if we have some weather coming in. Testing again. Okay. Okay, so it looks like the handouts made it through here in the webinar piece. Still trying on Patreon. Okay, so on the monthly health check, now we move out 2 time periods to the monthly. And what I've done on this one from a structural point of view is I've just highlighted in yellow the region under the dragon. You can see in the yellow. And the market closed right at the Bollinger Band mean, right in the middle of the monthly river. And so it has to get through that yellow zone of the dragon really before it can become long-term free and clear. So that price looks to be about probably 308 or 309. Support levels are the monthly low at about 283. The PSAR flip is at about 271. The previous belly of the dragon about 268, and which is also linked with Z1. If it falls below that PSAR flip, then that's the gateway to another set of those 2 spiky down moves. So that really is, we have 3 warnings to protect us against that. So you need to have an ironclad support at 268. Anything north of that is still cautiously optimistic. If it gets through the yellow zone, then it would be optimistic if we could get above the hump of the dragon. If it's in the yellow zone, then we're cautious. We're cautious right now until it gets into that and through it. And then those 3 price levels on the way down. Then you can see the Z2, the fair value, and the Z3. And you can see why those price levels are important for us when you see the size of the moves that are possible on these sell-offs. And what I want to do is go back and take a look at the end of 2016 and really all of 2017. Look how small those monthly moves are in terms of ranges. And it was during that period of time that the S&P's daily volatility was so low, it was down like 0.7% and everything was easy. It's when things get volatile that all the truth changes, and what used to be uncorrelated assets can become correlated. So we want to be mindful of what the volatility trends are telling us, and that's where the that risk Z really is our friend. Okay, so the Patreon message should be uploaded. It looks like the reports made it through there, so sorry about that. So that's what the monthly is telling us. Much longer term, it's cautiously optimistic because it has put in a pretty good rebound from that almost 4 sigma spike. But until it gets into the dragon, this is really, I'm more on the cautious side than I am optimistic. Once it gets into the yellow zone, I would be just my normally cautious self, but I am excessively cautious right now. Now I'm going to drill down to the weekly. Okay. Now, this is the same principle. So I'm going to look at first is um, the MACD seasons. We're on a weekly basis. You can see down at the bottom where we crossed the zero line. That's when the winter began, was in the third week of this horrible selling. So we had one bad week, and we had like a sideways week. It was volatile, but it closed right where it opened. And then that third week, big gap down, and then it just got crushed for 3 weeks in a row before it started putting in this nice recovery. So you can see right now that this last week, we got through the dragon for the first time, and the Monday, Tuesday, and Wednesday were both, all three, pretty favorable days. And it got through the PSAR flip, and everything looked smooth sailing. And then the last 2 days gave all of that back. And now we're back into the yellow zone formed by the dragon's body, and he's at the bottom of that river. And so we've just gone from optimistic to neutral in terms of direction. So I have no directional bias right now. And all it would take to adopt a favorable look is if it can get through that first green line at the PSAR flip. But if it violates the weekly low, then I'm getting cautious. I'm getting more and more cautious and pessimistic until it falls out of the dragon, and it looks like about probably 263. And if that support doesn't hold, then look out below. And then you can see the Z2, the belly of the RL10, and then the Z3. So these are all targets for price action on the way down, and each one of them could also operate as strong support. And then on the way up, what we'd be looking for is that the PSAR reversal, and then it should be free and clear back to the Bollinger Band mean, up to the weekly fair value at 310, then halfway through the river until it clears the river at 330, and which is also the hump of the dragon, and then the RL10 peak is at about 335, and then from there, that's the price level that would negate all of the bad feelings. So that would be quite a move. Hard to see how that happens in the same pace as the first half of this recovery. So we're really just cleared the halfway of the recovery, and that's actually easier and faster than probably that next half. So it's tough sledding uphill, and but that's what we're looking at. The downside is easier to believe in, and is likely to gather momentum traders at the first signs of weakness. So I'm really guarded about going into the week ahead. I think this week is going to be an important decision point. And then we shift down to the daily health check. You can see just by inspection, the big orange bar represents the 10-day high and low. That's strong support levels. You can see Friday's move opened inside the dragon, made a brief run up to the RL10, and then failed the rest of the afternoon to close near the bottom of the dragon, which is acting as support. The dragon actually rolled over, as you can see by the negative slope on the extension. The PSAR still is firmly in place here at 279. If that breaks, then there's not much support till the 10-day low at 272. If that breaks, then it's the reversion to the mean in the middle of the river at 267. And if that cracks, it's really look out below, because then you don't see another support till 256 down here at the belly of the previous RL10 excursion. So those are the measured levels of support on the way down. On the way up, it has to get back through the dragon peak at 286. It has to breach the RL10 peak and the high of the day from Friday. So it's got a long way to go just to get through there. Then breach the 10-day high. Then next stop would be long-term fair value of the RL270 at 300. So still quite a lot of volatile moves programmed ahead. We're right in the middle of that 10-day look-back period, 55 as you recall. So I want you to notice where price is compared to that big orange rectangle. So now when we come back and look at this first page on the report. I'll let that come up on your screen. It reads at 57. Right, so you can see where it says on the 10-day look back, it has an index score of 57. That means it's slightly above the midpoint of that 10-day range. So when you just look at that, it's almost like a thermometer. You need to start developing an appreciation of what that means on a visual basis. So this price level here is at the 57-yard line on the way up the stack. Okay, we're still in the boundary between summer and fall. I think Monday it goes into the fall because it'll drop off a selling day, and so that the MACD histogram is also warning us. So we have a number of warnings that the swing trade truth has just changed compared to the last 20 or 30 days. The last 30 days have been very strong. You remember that from the NDX reading, which was 87. But that's no longer the case. You have the 3-day NDX crack. The 10-day NDX is pulled back to the middle. We're back in the lower half of the dragon. The dragon has rolled over. The risk Z has rolled over, and the MACD histogram 4 seasons have rolled over. So there's 4 or 5 warning signs that this pleasant recovery of the last 30 days, triggered by $6 trillion of Fed money, those easy days are over. So it's back to tough sledding. So we want to be mindful of that in the week ahead. We're going to run through some blended monthly rebalancing portfolios right now. Each of these is a set of symbols that acts as a portfolio subset. And we're looking at the 1 week, 1 month, 3 month, 6 month, and blended performance. So this is how we compute relative strength for the blended monthly rebalancing system, which is that long-term core model. And in that one, we take the 70% of the 3 month plus 30% of the 6 month, and that gives us an aggregate blended percentage. And so these are ranked 1 to N on the basis of the score in that last column. So if you look at the ETF 13, treasuries have a blended score of 17%, which crushes everything else. The worst one is Latin America, which is down 43% over the same period of time. So the point of this is that you can have, just with 13 ETFs, a considerable variation in performance, which if you are sector cycling, you can actually use that to your advantage to find the strong ones, avoid the weak ones, and you can also use this as a guide to figure out where in the world money is being made. It's always raining somewhere, and in some places it's working. So that's how we formally use the 3 and the 6 month score to create the blended percentage. Now, to give us additional insights about shorter time frames, I added the 1 week and the 1 month percentage. Now you see that there's 4 categories: green, white, yellow, and red. So I color code that box in the same way that we handle all of our statistical coloring. We find the average and the standard deviation of that population, and then if it's more than 1 standard deviation better than the average, it gets coded as green. So right now, treasuries and the triple Qs are very strong compared to that 13 member population. In the white means it's better than average up to average plus 1 SD. So the S&P, Japan, and the Dow 30 are down 11, 13, and 15%, but that's above average, but not more than 1 standard deviation above average. So it gets coded as white. All these in the yellow are below average down to minus 1 standard deviation. Then Latin America is so horrible, it's in a class all by itself. So when you see these color bins, what you realize is that the exceptional performance is green, extreme underperformance is red, and then this cluster about the average. The average is in between the lowest white and the highest yellow. Okay, so that's how I read it. Now, the cash or buy signal is the moving average signal. So in the blended monthly rebalancing. We look to see today's price and compare that to the 4-month moving average. If it's above the 4-month moving average, it's shown as a buy signal. If it's below that, it's cash. So you can see right now only treasuries and the Qs are above their 4-month moving average. Everything else is still suffering. So now as we go through this next series of populations, you can use this as a way to get just a quick insight of what's going on in the most important segments of the world market model. And then you can be as detailed on this as you want. So the 13 ETF portfolio you see there and the 22. The 22 simply takes the 13 and then adds in the 9 S&P sector spiders like XLE, XLB, and so on. And that gives us a deeper dive into the U.S. large cap market. So you can see right now in the ETF 22 that healthcare joins treasuries and the Qs. Now, on the 1 week and the 1 move, those are not part of the rankings, but those are the faster time periods, and they can give us some insights into where the turning points are. So I want you to look on the ETF 13, and I want you to notice the extreme outperformance of the mid caps MDY and the Russell 2000 IWM over the last month. They're in the middle of the pack on the blended percentage. But over the 1 month period, they both staged really strong rebounds, and that looks like the aggressive swing traders are starting to take positions in the U.S. on the basis of all that Fed money getting pumped. So those things are accelerating their performance in the short term. Whereas Latin America this past week was up 3% while everything else was getting smashed. Now, you can imagine what the chart of ILF looks like. If it's down 42% over the last 3 months, but it's up 3%, then you should be able to construct in your brain a pretty quick estimate of what that thing looks like. If we looked at it on a weekly basis, that's exactly what you would expect. This absolutely miserable performance, and it has not rebounded as strongly as the S&P, but it actually had a better last week. This last week was much better, and it was up 3% close to close. So whereas the U.S. market is threatening to roll over after a nice bounce, EWZ hasn't even recovered. All it's doing is hammering out a bottom, and the weekly close was more favorable. So that's actually the difference between the Brazil market and the U.S. market. So now that leads me to think maybe this is money that's cycling into Brazil and they think a bottom is in, and now that's a low-risk trade somewhere in there. So it turns out that Brazil is a special case, just like Mexico. They're both frog champions on intraday and swing trades. So they are always on my list of things I'm ready to trade intraday with a hybrid frog and then chain trading. And then if it closes well, I'm interested sometimes in turning that into a swing trade. So I'm actually very interested in Brazil right now. Now, as I'm going through this weekend report, let me just pause and say the way you do this now is you start looking at some of these different ticker symbols and start looking at reasons why they're interesting. This is all part of planning. What we're trying to do is identify some symbols that are postured to make larger than average moves in shorter than average periods of time. We're looking for interesting narratives. So I just made the case there why Latin America and Brazil could be interesting, separate and distinct from the U.S. market, because the U.S. market is ready to crack, but Brazil is just starting to recover. You can see just by looking at this chart, if it can get above these weekly highs at about, call it 26.15. In other words, if you can get above the weekly high at 26.15, like right here, there's no reason not to try that, because that would be a 1, 2, 3 entry, and we would have seen that the RL10 has already rolled over. So we could think about putting some positions in here around 26, And then if it can get through the skin of the dragon, what we will have is, yes, the RLXD. So I'm now starting to build a price ladder in my mind for Brazil. In fact, I can say I'm interested in it here, and then I'm interested in it here. I'm going to make that a blue line instead of a red line, because now I'm kind of really interested in that one. All right. So, and you can see that we've been very active trading this intraday and on a weekly basis too, because it's a frog champion. So that's what I want to say about that. Okay. So that's the introduction to how to use that chart, that table right there. This is using the information that comes from the long-term system, the blended monthly rebalancing, which uses that 3-month and 6-month and blended percentage. But that also gives us some additional information about what's going on in the market, and we might be able to find a way to do some faster swing trades here in order to act core and turbo on these weekly charts. So core and turbo doesn't just mean intraday trading and swing trading. It could also, on a slower time frame, using swing trades as the turbo and those long-term position trades as the core. So there we are. So the things that jump out at me on the 22 portfolio is that consumer discretionary in the XL series, XLY, had a pretty good week as well, and a good month. And energy, now this may indicate to us that the energy shenanigans are over, because XLE has had a very good month and a very good week after just brutal 1 month, 3 month, and 6 months. So maybe the bottom in oil is in, and maybe the companies have weathered the storm, and now maybe there's quality on sale, because we're going to need those companies to continue to run the world in the civilized way. So energy sector remains very interesting to me. That also triggers a note to myself, keep an eye on Chevron and Devon Energy, because those are my two favorite trading vehicles as individual energy companies inside the energy sector. So if the market is doing neutral, but the energy sector is good, but Devon Energy is even better, then that gives me a reason to focus on Devon Energy, because it has relative strength compared to the sector in the market. So that's how we use that logic chain to go from market conditions to sector conditions to individual company conditions. And that's how I use this chart on the weekend to set up that narrative that's going to last the whole week. ETF 32, this adds now the ETF 13 plus the sector spiders from the ETF 22, and it adds 10 more global ETFs that represent broad asset classes like SHY, Treasuries, FXI for China, DBA is the agriculture. There's a, let's see, what's another one there? IYR for real estate, and so forth. So now we can see we have a few more choices and a little more fidelity. So one of the things that you need to consider for your dashboard is, what's the minimum number of targets you need to have to ensure that you have a trading target every day or every week? And then what's the maximum number that you can manage in an effective way? Like, you can have too many things on your dashboard, and that could lead to analysis paralysis. So the idea of dashboarding is something that helps you through that span of control and what's efficient. I try to keep all the signals on one screen at a time. This is the Dow 30, so I apply the same technique to those 30 large caps that I study. This is the Dow 30, plus I've added Amazon to it, I believe. I thought I put Amazon in there. Nope, looks like I will, though. So right now, the interesting ones to me are the ones that did really well this week. Boeing and American Express, Nucor Steel, Visa, and Apple. So Apple is the most interesting one to me right now. And the reason is it's high in the stack at minus 1.95% on the blended. reasonably held up over the last 3 months. It's only down 10%, but it had a really strong 1 month and a really strong 1 week. Both of those coded in the green says that they were exceptionally strong compared to the other members of the Dow, and they made it through their earnings season. So this might be the case where Apple has weathered the storm, going to have a strong consumer interest in them. They're moving their manufacturing back to the States, so they're going to get some positive feelings there. And they weathered the downside of not giving an earnings forecast for the next quarter. And they seem to weather that storm pretty well. So Apple is on my short list of things that are very interesting. Okay. Yeah. Sector spiders. The interesting ones are I always like looking at the 1 week and the 1 month. These things that were in the green down here at the bottom are just more fuel for the fire that talks about why energy is interesting. Look how horrible energy, oil and gas exploration, and oil and gas equipment have been 3 months and 6 months. Absolutely crushed. Nevertheless, look how strong they've been 1 month and 1 week. Look at XOP, oil and gas exploration, a very liquid ETF, which is up 60% over the last month. Normally, you wouldn't expect to see something like that unless it was a high-tech IPO. But here's an energy sector trading like some kind of crazy growth stock. So if you pick the members of your dashboard properly, you can get an amazing and an interesting set of trading targets just with ETFs and not having to go down into individual companies. There's reasons to go into companies, but you can make a living on just the ETF cycling too. Home builders are interesting to me too, also at having a green score on 1 week and 1 month. That's bucking the trend. So let's keep an eye on home builders, because that's going to be a front runner for economic indicators for the economy. Lisa asked me, how do I calculate the blended percentage? Again, you take 70% times a 3 month plus 30% of the 6 month, and that gives you the blended score. In the hybrid course, you'll see the system definition for blended monthly rebalancing that gives you a 10-page discussion of how that long-term process works. Okay. XL, you asked me why don't I have XLC? It's not been around long enough. Now, finally, ETF Max looks at about 300 ETFs, and I'm just looking for the really maximum performers and what they're doing. So you can see how volatility has really started to thrive again with VIXY and VIXM. So I'm really just looking to see how the Uber winners are working. And after volatility, it's been gold. Okay. So when I'm playing gold, I use WPM, Wheaton Precious Metals, as my proxy. Now, shifting into the world market model. So in the ETF2 system, and the system definition is in the hybrid course in the file section, we are measuring 3 aspects of ETF performance compared to their peer groups: strength, consistency, and quality. The strength rating is that blended percent return, that 3 month and 6 month. We then evaluate everything by that blended percentage and then assign it a score between 0 and 100, and that's what we mean by indexing. The ETF2 system description covers that. And then we color code it in the same way with the green, white, yellow, and red. So if we look at the regional summary, we see that the Qs have a strength rating of 83, so they're very strong compared to the next strongest thing, which is US large caps, and then Japan. Everything else after that is yellow and lagging, except for Latin America, which is just horrible on the strength rating. Now, we recompute that every week. And so strength is the relative strength score this week. And then consistency is the 10-week moving average of that performance. And then quality is like a 40-week quality number, system quality number. And all of those are scaled 1 to 100. And then the average of those three columns gives us the average column. So I use the strength column for my default sort when I'm looking at ETF2. And then I use the color codes primarily to help judge where we are. Then you can see below that the 9 sectors of the S&P, and then the broad asset classes, where we look at the S&P versus treasuries, real estate, commodities, gold, and oil. And that gives you an even broader look at some of these markets beyond equities. And again, the buy and sell signals are compared to about a 5-week look back. The ATR just gives you the average true range in dollar value. So if you were using that if you wanted to go look at charts, you could quickly construct their scores. The world market model visual on the right-hand side shows in the center world market model based on large, medium, and small cap, and then value, blended, and growth. That's that Morningstar style box, and that's described in better detail in the market classification white paper that's in the hybrid trading score. But this gives you kind of a market picture at a glance. The U.S. in the middle, Asia and Asia less Japan on the left-hand side in the Asian countries, Europe and then the Euro countries on the right-hand side, Latin America and emerging markets, and then the Western country, Canada, Mexico, Brazil here, and then some other asset classes to the top. So this is almost like a radar screen that starts with the U.S. This one in the middle, that's the blended large, that score of 71, that's actually the S&P. So if you looked at on this table, the 71 for the strength column for the S&P, that gives you the 71 in this little table. The Qs are this upper right-hand corner, large cap growth, that's 83. And you see that's the 83 under strength over here. And the Dow is at 67. Okay, so that's how you read that chart. That gives you, at a glance, almost like a heat map and a performance map. Now, this is an extract from that ETF2 database, and it's still the same numbers that you've seen, only now what I've done is I've sorted that and taken the top 30 performers based on the strength column. Now, this table above here is a strategy guide. This is like a little playbook that says, just using this table, I can construct some different trading ideas. So the first thing I want you to notice is we're looking at the strength column and the consistency column to build out this little strategy. So these are the combinations. I could have green and green and strength, and green and consistency. These are in a leadership position, and they're doing great. Everything that's green on strength is doing great. They are the leaders in the big ETF database. Green and green means not only was great on a consistency basis, 10-week, but great on a strength basis this week. So it's still great. Now, if something was green and white, we would read that as it's still doing great and it's a leader, but the last 10 weeks it was only above average. It was white. It was good, but now it's great. So when something goes from good to great, it feels like you're on the early days of his exceptional outperformance. So our swing strategy would be to look to find ways to exploit new strength. Okay? Can we turbo this intraday? Yes, we certainly can. And why? Because these are the new leaders. So let's look down in this chart, and there's two symbols that fall into that category. XBI, which is S&P Biotech, has a green and white, and then healthcare, XLV, has a green and white. So both of those are relatively early in their outperformance. Their performance and strength is strong, they're green, but they are improving over where they were. Now, if you look at something like, let me try to find one where it's kind of inverted. If you look at like, let's just look at government bonds, GOVT. It's an 89 in strength and an 86 in consistency. So it's been consistently strong for 10 weeks. That run may already be done. Mic check. How we doing? Oh, okay. Sorry. Thanks, Lisa. All right. So right now, if I'm making notes on targets, XBI and XLV are both potentially strong because they are early in maybe their parabolic move. Whereas something like treasuries at 100 and 100 may already be fully valued. It's hard to imagine it can be much better over the next 3 and 6 months. So this helps us quickly find some strategies. Now, I only show on this one the top 30, so this is almost always going to be your greens and green and white, and I usually try to go down to the first thing that is only good or above average. In this case, it's white and white. So XLK, which is the S&P sector spider for technology, has a strength score of 79 and a consistency score of 71. White and white means that it is consistently good. Last week it was good. This week it's still good. Nothing special to see here. All other things being equal, like if you had positions in tech, that's okay. But it didn't get better week over week enough to really make it stand out. Whereas healthcare and biotech have experienced a sudden increase in relative strength that may be even more interesting. Okay. Now, you can work your way down all the way through the bottom of this list. And if you saw things like USO oil, it would be red and red. It was terrible and it's just horrible, never getting better. If you were a bottom feeder like me, you might actually look for yellow and red. Why? Well, it was bad, meaning on a consistency basis, it was red. It was bad, but now it's just weak. That's actually an improvement. That could have been something that bottomed out, is at the bottom of its channel, like a catfish, and starting to recover. And so this might be a way to start exploiting new strength in the spring. If you think about this as the MACD histogram, things that are green and green would be like in the summer. Things that are green or that are white and green might be the fall. It was great, now it's just good. So we want to preserve profits and watch for the resumption. So if something went green, white, green, that would be really good because it or white, green, something like that. It goes back into the green. It's starting that next leg up. So this is a table that gives you some ideas about how to trade different elements in their life cycle and helps you see that it's always raining somewhere, it's always sunny somewhere, and that just like the weather and climate, things go through phases. And this gives you some ideas on how to do rapid triage of the stack. And then the last page in this weekly strategy report simply identifies the top 30 ETFs by average daily dollar volume over the last 30 days. And then also gives you what their ATR percentages are, so you can see what are the most liquid and most volatile traders. So if we look, I was looking for XOP. Yeah, there he is. So XOP, you see right there in the middle, it's like number 15 in terms of volume, and it has an ATR percentage of 6.7%. So this thing is extraordinarily liquid and extraordinarily volatile. So no matter what else, this thing makes an outstanding short-term trading vehicle for intraday and for swing trading because it has tons of volume, so the slippage will be small, has a lot of people interested in it, and has a lot of volatility to support these short-term moves. And then if you get one that's in your favor, you can make a decision to get out of it quick and take your money and run. So so that whole report that you just saw there, I update every week, and then that's the first thing that I look at, and that is going to be my guide of market conditions for the tactical 5 days ahead. Okay? So I'm going to take a 3-second pause there and say that is the weekly strategy report. That's the first part of a 3-part series. Okay? Thank you for hanging in there. Moving on. Now we're into the daily report. This is Friday's daily report for Monday. Now what we're looking at is we're going to drill down our time frame and just look like 1 day ahead at a time. So this is the daily pulse. So I'm going to go through that pretty quick. No change to the market health check. You've already heard that. You've already seen these pieces, some of these pieces already that were extracted and put on the weekend chart, like the market classification. Let me let the video catch up. Sorry. So this is the, you've seen some of these tables already. I extracted them from the daily and put them on the weekly, and they were the most important things to me, and that is market classification, the NDX look back, and this little market mosaic, plus the risk Z. Those elements are so important to me that they are on the top of the first page of my daily and my weekly. That should tell you how important I think those things are. The other aspects of this page give me some quick ideas about the day ahead. This middle section on gap statistics simply describes the characteristics of the S&P's gaps. The way you would read that is kind of the following. And I want you to notice why this is interesting. So there are 4 things that can happen. Gap down, meaning it opens lower than Friday's close. It could gap down and then close lower, or it could gap down and close higher than the open. So let's take a look at that. In the last 30 days, it has gapped down and then failed lower 9 times, and only 3 times did it gap down and then reverse and close higher. So 3 to 1. Each time the follow through from open to close was about 1%. So the gap down, all other things being equal, the gap down right now tells you a gap down, you should be more worried about further failure. So why is that important to you? That's important to you if you're a hybrid frog trader or a chain trader. That means if you see the futures opening lower, then you want to make sure that you take that hybrid frog move to the downside. Because 9 out of 12 times in the last 30 days, it's followed through in a big way to the downside. Only 3 times out of 12 did it close higher than the open. Now I want you to go to the left side of that and look at the last 200 days and now compare those two things. The truth is very different when you look back 200 days. When you look back 200 days, the number of times that the market gapped down and then continued to fail was 42, and the number of times that it reversed and closed higher was 44. So it's not 3 to 1. It's basically a coin flip. And you see the moves were much lower, and then the gap down failures were significantly larger than the gap down and reversals. Well, that's weird, isn't it? That's how much the truth can change in just 30 days about how to play the gaps. So I say this just in order to say the following. Whenever you read guys that have magic bullets and they can teach you to trade in 5 minutes by how they trade the gaps, I wonder if they know how much the characteristics of the gap change through time. And that I could imagine a strategy that would work for the last 30 days, but which would fail over the last 200 days because of the truth about how the gap follows through could be very different. Let's take a look at the other 2 things, which are even more interesting. Now, if you have a gap up in the last 30 days, it gapped up and then continued to go up 13 times for an average follow through of 1.58%. But the gap up and then reversal, so the fade, the failure, look at this. It only happened 5 times, but the follow through was 2.26%. What does that tell you? Let's take a look at Friday's price action. If I can pull that up real quick. Friday's price action was a gap up and then sell off. Oops, I'm on the wrong one. Yeah, that's weekly. Sorry, let me get to the daily. So Friday was a gap down, close lower, and then look at the size of that move. So when we have gap down, when we have a gap in either direction and it rolls over, that tells you that's the leg to really exploit. So even if you got a hybrid frog to the long side and then it gave you an exit because it's rolling over, you want to stop and reverse that one automatically while the market is in this condition. Because look at the size of the follow-throughs. The follow-throughs on that one is 2.5% or 2.2%. And when the S&P is trading at 300, that's a $6 intraday move. And so if you are able to trade with a 25 cent or a 50 cent, you're talking about a 10-to-1 intraday reward to risk box. That's why we get paid for the minimum manageable risk box. So that's how you read the gap statistic. That's all I want to say about that. You can see the risk Z times thing again. The channeling and overreaction systems are conservative, purely mechanical systems for the large indexes. For you hybrid traders, the system definition is in the course material in the file section. Go read it. They are highly reliable and only 2 or 3 rules and very clear way to start mechanical trading. The signals are so reliable that when I get a signal and it would fire with a green or a red, and none of them fired right now, then I go ahead and prepare to trade that intraday with turbo. That's how good that is. I put the pivot points on there to just show the price levels that come from the futures pits for these very big broad indexes. And intraday, you can use that to refine your estimate of where price action occurs. I'm still on the same screen. The 10-day min pain and max pain are still those signals of the ones that have sold off the most from their 10-day high. So those are candidates for rebounds, the 10-day max pain. 10-day min pain are the ones that are the strongest relative strength. So again, you see Microsoft and Pfizer in there with good reason. Next one up is the Dow 30 Tactical. Let me wait for that to come up on your screen. Okay, so the Dow 30 Tactical, you've seen this before, a handful of dojis, and I'm just going to start reading these the way that the way I'm scanning. The first thing that I look at is the numbers 1, 2, 3, 4, and 5 in the max pain range compression. And I like what I see in Walmart. Number 1 max pain range compression, it was a percent leader. It was the only thing that was positive in the Dow on Friday. So I already like Walmart. Then I like to look at the auto framer to see which ones are postured the best in their 10-day trading range. So I like the looks of 3M. It's in a doji and has a 5-to-1 reward to risk ratio on a swing trade. I like that. I like Goldman and Nike for the same reasons. Only Walmart broke down on its 10-day look back period. It was at -2. Everything else is still firmly within its 10-day trading range. So when Walmart was at -2 on its 10-day and yet it is postured well. That tells you how bad the rest of the market was, but it also tells you that Walmart has a very nice distance to travel back to its 10-day high. It could be very interesting. Shifting to the ETF 30 tactical, let me let this come up on your screen. Okay, so the symbols that leap out at me here, USO oil at 15-1, that's kind of an anomaly because of that price crash. But also, I want you to just notice, a 15-1 auto framer reward to risk with a 15% ATR percentage. And then look at the reds on the price change. That thing is by far terrible performance on the 10-day, 1 month, 3 month, 6 month, and 12-month look back period. Whereas if you go down a little bit further, you see that cluster of green for treasuries and gold. Treasuries, gold, and healthcare have been very strong on the 3, 6, and 12-month performances as those defensive plays. So I want to go look at XOP and XLE. In the red on their symbols, the tickers are highlighted red. That means they were absolutely horrible on one-day performance. XOP was down 8% on Friday, the worst performer by far. It was even worse than the triple Dow. And we also know XOP was very volatile and very liquid. So it may be that XOP is something that I can look at. So I'm going to go plus XOP. The sector spider for oil and gas exploration. Okay, so now we're looking at XOP, and I want you to notice a couple things. First of all, it had this beautiful long pattern put in at the bottom. Notice how the dragon has sort of identified that support level in here. And the dragon is that 10-day moving average plus or minus half a standard even. Look how tightly defined that dragon is right there compared to how wide those daily moves are. The dragon is a way to statistically simplify it to the meaningful level. And you notice that he's absolutely flat. So his so that's a sideways quiet channel right there. And then it had let's see, one nice move up, a little channel, a second leg up, and now it just started this first little retracement. Now that could be, this is the technique of that visual box trading. Okay. So if I just take this and say, now, when I quickly look at that, I see it found a support level, one leg up, pause, two legs up, and now how do I treat this 8% sell-off? That 8% sell-off could be just normal noise. It just came back to the edge of the dragon. Maybe there's nothing to see there. But maybe it's part of a big sell-off because it was much worse than the market. Eric asked me, what's the difference between skinny and fat dragon? That just tells you how directional those 10 days were. So when you look at the statistics of it, this sideways, I want you to notice this sideways period. So this is a deeper understanding of the dragon. We're going to go back 10 periods. All right, so 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So that is from the highest high to the lowest low of the last 10 periods, and that creates a very narrow dragon because there's not much deviation away from the average. But if you look at where the dragon was fattest, it's right in this period here. Look how wide that dragon is here compared to look how skinny the dragon is here. Let me certainly bring this down from the width to the width, right? You see the difference in the width of the dragon? And that's because the previous 10 days from here had a low and then a high up here. That's the 10-day trading range back here that produced a very fat dragon because it was so vertical north to south. That range was wide. But this relatively narrow range here produces a very skinny dragon. So when the dragon goes sideways, he's very thin. That's one of the characteristics of the dragon. So you need to understand that about him. And that's just driven by the mathematics of it. So now when I'm looking at XOP as an interesting candidate for visual box trading or hybrid trading, I'm trying to estimate what should I make of that 8% sell-off. It feels like it was horrible, but I want you to remember the ATR percentage on XOP was 7%. So that really was just a normal one-day move. So even though 8% looks like crazy and wild, that was a normal move. And that normal move brought it right back to the edge of the dragon and fair value. Look at that. So I could actually think about trading this if it broke down below, I might put a short there. If it broke through the dragon, I'll put a second position, a third position at the PSAR flip, a fourth position maybe at the Bollinger Band mean. And that would be my target on a reversion to the mean trade. But on the upside, what if it started working? Well, if it broke out above the peak of the RL10 and it took out the high of the day, then this sell-off would mean nothing. So I might go there. I might add at the 10-day high, and then I might add halfway up the stack to the Z3 to try to take advantage of this thing going up. Because look how nice and strong it was from this little rebound. That's a really nice regression channel I'm just drawing right there by eyeball. That's a pretty strong move. Notice how strong and straight the dragon was for that entire move. So I'm of two minds on XOP. On a short-term basis, I love it intraday because it trades so directionally. On a swing trade, it's postured to make a big move Monday in either direction, which I can start with a hybrid frog, and then I'm going to go in the direction that it closes. Like if it has a big sell-off tomorrow and goes through the dragon, I'm holding a piece of that as a short side swing trade paid for by market's money. But if it clears the top of that red box, I'm going to go long. Now what you hear me doing is not just planning, but I've actually started to prepare things that are really attractive to me. So sometimes we can blend that planning and preparation while the idea is strong. Okay? Let's get back to the daily report. So I want you to see how you can go from an idea to a tentative trade frame, and I want you to see how you can start pulling pieces of these symbols and reports together to start coming up with some trading ideas that will be unique and therefore potentially lucrative for you. Okay, so that's the ETF tactical summary. Pinch and stretch is the next chart. Let me let it come up on your screen. So pinch and stretch, just those four columns are explained. First column, these are candidates for a continuation or reversal because they are so strongly stretched above their river. So when a thing is moved like that, it may have already made its parabolic move. Like Pfizer is 7% north of its Bollinger Band mean. So it's at a z-score of 1.55. And Nucor is 10% above its Bollinger Band mean. And all those numbers that are stronger than 1 get color-coded green, meaning they're out of the river and to the north. Second column, the most negative z-stretches are the ones, how far have they stretched below their Bollinger Band mean? So USO is even out of the floodplain at minus 2.8. The most expanded pinch boxes are the ones that have had the strongest directional 30-day move. So they have already experienced a strong swing trade move. They could be candidates for continuation, or they could be ready to reverse. So that's what the little chart at the bottom shows you, is it suggests the kinds of strategies that column, that set of candidates might support. So if you know what kind of a trader you are, and you know what kind of things you're trying to build, maybe you want some trend following things. Maybe you want some channel band trading. These are different ways that you can zero in on candidates that are set up and structured to trade in that way. That's how you use that report. The auto framer and the RLFF, I've beaten that to death in the dailies. So I'm not going to cover that anymore. The daily squeezes, again, these are the ones where the range on Friday was so tightly compressed. Let me let it come up on your screen. The daily squeezes, again, are so tightly compressed that if it just makes an average move or a range stat move and opens inside the range and then breaks out of the Friday's range, then I'm going to automatically go in that direction with these because they're postured to make a really strong move. And then I can use the size of the range on Friday as my minimum manageable risk box for a very relaxed, structured, one-day swing trade. Okay? So that's how I can start a swing trade, and I call this a day one technique. And this could grow into a longer term position. And you've seen me build positions starting off with a turbo and then keeping a piece. This is how I do it. Okay? Thanks for hanging in there, guys. You're doing great. The Four Seasons just gives me a quick visual again on where they are in the climate, and it gives me overall a feeling of what the market posture is too. Everything's in the fall. The NDX time frame, I've already covered this and in other lessons where we look at the size of or we look at the look back periods and then where it is on that thermometer scale. Look how many things broke down on Friday compared to their 3-day look back period. Things got smashed. The rest of these charts are in the next layer of detail on market classification and posturing, and that's a very, very advanced stuff and not required for our hybrid trading. But when you get bored or when the market is slow and you don't want to overtrade, you can start drilling deeper into these things to give you some different ideas. But these are ways that I can start developing a deeper appreciation of what's going on in the market. So that's all I want to cover on those. So I'm going to zoom to the end of that's the end of the daily report. And so what I want you to remember is when you look at the cover page, let me let this come up on your screen. Hold on. Almost there. Okay, so this is the cover page of that day of the daily report. I want you to know it has two big sections, blue and white. What we just did was go through the pages 2 through 11, and we looked at a number of different. Each one of those is a strategy that gives us some insights into coming up with different targets. And so I just flipped through those. Those are my signal generators for short-term trading ideas. I want you to think of this as a salad bar or a supply catalog. What you need to do is figure out what kind of a trader you are and what you want to be and how you want to exploit your skills. And then find those specific pieces of the daily report that give you actionable information for your set of targets. You don't have to master all this stuff. You only have to master one or two things, like that RLXD entry and the owl and the chain trading, the collapsing dragon. That's enough. You know, the MACD histogram and the minimum manageable, that's enough. You don't have to understand each and every element of every page of every table and all that stuff. But the point is that there is a comprehensive and robust set of strategies and systems that allow you to pick and choose. So you should start with what you're trying to achieve, what kind of trading strategies and systems and candidates you want, and then find the information you need to make your dashboard. I'll just put a plug in for that. The TC2000 bundle is a way to also do that, so that you're not tied to my report. You can actually reconfigure the screens with all of these indicators and all these strategies and all that to make just the ones you want. Plus, I only look at, you know, the 30 members of the Dow and the 30 members of the ETF 30 plus a handful of specials. And you might want to trade in other things. You're one of the ways to get information independence and build your own tool set for your own dashboards is that one. So that's a long-term decision for you, a long-term consideration. If you're in the hybrid trading course, or if you're a Patreon subscriber, you will always have a $1,000 coupon to buy that anytime you want. So there's no hurry. And those of you in the hybrid trading course can look at lesson or the course number 001. It just gives you about 30 different 3-minute lessons that show you how to do dashboarding and how to use TC2000 to structure. You can do all that stuff on your own in TC2000. I mean, there's nothing magic. It's just hard work. And Danny has done an amazing job of putting that together in a very pleasing way. So just consider the time value or the money value of your time. And you can duplicate all that stuff in whatever broker platform you're using. So we really just offer TC2000 bundle as a time saver, administrative support. Okay, so let me. We're now going to go to the last 2 pages of the weekend report, and all I want to say on this is, if you remember that table where I gave you the green and green white, and we were just looking at the that little table of strategies. The last 2 pages on the weekend report has the top 100 ETFs based on liquidity, and then you can see the full set. And that this is all sorted by the strength column, so you can see in the strength column it's green, white, yellow, and then on page 2 in the red. So we've already seen what's green. What's just horrible right now? It is, let's see. Yeah, it's regional banking, energy, oil and gas, Brazil, and then United States oil. Look how bad oil is, 0 and 5. And there's nothing in that yellow and red category. The weakest yellow candidate is at IWM, the Russell 2000 small cap value. So this just ranks everything by that column, that strength column. So you could actually use that table, and then you can see rapidly where all these members, all of these are tradable intraday because they all are very liquid. And then I just want you to notice over on the side, it has the ATR percentages. That's that daily, it basically shows the daily volatility. And I want you to notice that gold miners, GDX, has an ATR percentage of 4.84. That means its average daily volatility is almost 5%. And it's extremely volatile, extremely liquid. And with a 4-month moving average of 28, it's cheap. So that's how you might use it. And then you can see the moving average signal is either buy or cash, and that's price relative to the 4-month moving average. So everything that's in the green, these are the ones that have been suffering the least in this time of the virus. Okay, so that's that. All right, so take a deep breath. That's the weekend report. And I'm going to put that recording as a lesson in the hybrid trading course. And I will post this on Patreon also so you can listen to the replay. Sorry about that, how goofy it was at the start, but we got through it, okay? Now I want to shift to an exercise for that SPCE. And I just want to briefly revisit the lesson. So first things first. Oh, called it up in the wrong screen. Moment. Okay. So on the top level, what I want that was IWN, Lisa, IWN. That was at the bottom of that stack. It was actually worse than IWM, although IWM was pretty bad too. So this is the broad category of top-down trade framing that I want you to talk. That a flash card. So this one's fast. So I want you to imagine you have all these different swing systems and strategies that are firing different kinds of ideas. Some are trend following, some are trend collapsing, some are trend reversing, some are breakouts, some are band trading, whatever it is. Some of it is a mechanical thing like the 5 days down or the channeling. Some of them could be the auto framer, whatever. So just imagine that each one of those swing systems has a typical follow-through pattern when it works, all right? And I want you to imagine, and I want you to know that most of those mechanical swing systems that I teach in the mechanical course at the Tharp Institute and all that, they tend to work in about 5 days for about 8%, okay? 5% in call it 5% in 5 days. It's a directional move. So I want you to imagine that you take some swing system and the criteria are met on that given day, whatever it was. And then you set up a little trade frame where you identified the green line was your entry and the initial stop was your exit. So you have the green line and the red line. The blue line means you're stalking it. And let's suppose that it opened inside that yellow zone and then took off. If that thing gets 5% in 2 days, you could imagine that would look like a green line, the green dotted line. The trade is outperforming and we get our 5% gains in the second day. We didn't even have to wait for 5 days, just a second day. Let's say if it never even moved at all, it's that dotted orange line. It's horrible. And maybe we had a time stop in here, so we gave it 2 days and then started like a PSAR. And if it didn't move by then, we might just get out because it should have started working by now. And if it didn't, it's dead money. So maybe that's what that orange line. And then maybe the black line is a perfectly efficient line. If we said it's going to gain 5% in 5 days, we might just draw that as a straight line. The same way that we were drawing that PSAR extension and the dragon extension, we just project it forward. If it just stays on the purely efficient glide slope, it might give us this black line. And then if it was underperforming but was still gaining, it might be this dashed blue line. Maybe it was good enough to stay in because we didn't have anything better. So now I want you to think about the system's edge is that when it works, it gets 5% in 5 days. And anything better than buy and hold, which is this dotted orange line, long-term buy and hold is so close to zero that it's, all you got to do is have a system that reliably outperforms that, and that's your edge. So whatever your edge is, how much better than buy and hold is it? Now we can think about each of these systems produces a standard histogram of results. And when you take a trade, it's because it has a robust base of evidence that says over long periods of time and lots of signals, it does pretty well. And so you get something like, and then it has this average trade that performs like the black line. So you buy it because of the potential that is implied in the histogram, that maybe it's going to continue to perform the way it's always performed. That's a reasonable position to take, and you're betting some money on it, and a reasonable amount of money for asset allocation. So you're buying the potential, and then the trade starts working. The longer you're in the trade, it's less and less a potential trade and more your actual trade. So if it really starts going well right from the beginning, it doesn't mean that you were right this time. It only means that this time it's just working really good. There was no way to predict that it was going to be like that from what the setup was saying. Like you couldn't pick that out of a head and say, that's the one. I should have known. You can't know that. Only in hindsight does it look like you can figure out why. And that's our monkey brain trying to come up with explanations for that good behavior so that we can repeat it. Don't fall into that trap. That's the recency bias. So the way I look at this is I say, look, on this, say, 5-day down swing trade, what I was hoping to get is the black line. I want to get 5% in 5 days. So if I get 5% in 2 days, I don't suddenly think, well, maybe I'm a freaking genius now. And now this is going to be the one that goes to 100. I have no evidence for that. That's my chimpanzee, greedy monkey brain telling me that. So if I get 5% in 2 days and I'm good to go, I'm not going to take any extra risk on that one unless I pay for it with markets money. So I say that to help set up the SPCE trade frame here in a little bit. So when you hear me talking on the daily health check about where price is with respect to the RL30 extension line and the dragon and the RL10 and the 10-day high and low, I'm really looking at trade location and its time series and its momentum and what the slope of those lines look like compared to that grindingly efficient 5% in 5 days. 1% a day, that's what I want. I want things that are better than that. If it could start off to the west of that green line and then slowly decay and decay and decay. And the thing is getting worse and you got evidence of it, but because it started well, you keep trying to tell yourself, no, this is the one, I'm going to stay longer. Don't do that. Figure out what your stop strategy is before you fall in love with that damn thing and be ruthless on it's like a prenup on your trade. always have a prenup and never get rid of it on your trades. If you get married, unless you're a billionaire, I guess, and if you're a billionaire, what do you care? If you use prenups, then that says more about you. So anyway, I digress. So top-down framing, this is a really important top-level flashcard for you to consider, okay? And then remember, when we are structuring the trading process, those are the questions that we ask each time. And I asked you to go through those questions when we looked at SPCE. I want to give you an opportunity to finish going through SPCE, so I just want to remind you that SPCE was a case where we started turbo in a hybrid frog, and then we made good money all through the day, and in the afternoon had that nice big breakout, so we were holding 8 to 10R, traded at, if you were using $400 for a bullet, you could come out of that day up $2,000 or $3,000. And then in the last trade, on the last trade, you got this green dot, and you're holding anywhere from 50 to $125 in hand, and it's coming into the close with 10 minutes left, and you got to decide what you want to do. Now, what can happen is you could get tunnel vision if all you did was just looked at this thing in isolation. Like if that's the only thing that you could see, that's a different view of the world than if you zoom out and look at that thing from a distance and go back to the higher time frame. So when we look at the trading process, those questions allow us to bring in all of our rational mind and all of our little habits and indicators, and allow us to get over the emotion and then to build a professional trade frame. So that's what I was asking you to do. You're holding you're holding 500 shares. Sorry. God dang it. Come on, Kenneth. Again, you're holding 500 shares. You have a no lose plus dinner for two stop built in. In other words, you got in at the green line. You moved your stop up to this next red line. You had a small risk, and you just moved it up to no lose plus dinner for two. You got 10 minutes left before the close, and you can see the price level right now is the black dotted line. This solid blue line was like a high of the day. These thick yellow boxes are previous support levels where it got sideways quiet channel. So there's at least 3 levels of support where people were buying and selling. And this is where you made money on the short side on the left in the red. This is where you made money in the green on the right-hand side. And this was that long, strong period of support and where the VWAP used to be. Look how much the VWAP jumped, how much buying pressure there was that pushed it north. So what I asked you to do was, do you get out right now and bank 125? Do you wait for the rest of the day and see what you can get, but get out at plus 50 if it sells off? And then do you hold anything overnight? So I've had a number of guys already put their things in. Some guys got out of everything automatically. Some held it overnight because of market's money. Some guys did partials. Some guys got out and then built a plan to get back in on Monday once they did and see some hybrid frogs. So I've already seen 8 different trading plans, each one different than the others, and all of them off the same exact condition. So if that many guys can have that many different programmed decisions, think about how many other people that are out there not looking at it this way, but making their own emotional judgments. So that's where volatility comes from. And remember, nobody else is looking at the same chart you are. And nobody else is going through your process. You have a unique trading process in your head. And phase 1 of this task is to go through your trading plan. Now, while you do that, I want you to notice how you make that decision. I asked you to try looking at these questions in the trading process to do a structured approach. Even if you're not a structured trader normally, this is a chance for you to go through my process of structured trading to try it on for size. That's presumably why you're here. And then I gave you an additional chart that gives you all of the price levels. When you go back and look at daily charts, you can now see this thing has gone from 34 down to 9 in the last 3 months. And here it is, kind of like right, and you can now feel that dragon, how smooth that is. Look at how smooth the fence is. That P-star is like a fence. And then notice how smooth that blue line is, the RL10. 1, 2, 3. Notice the 3 higher low, higher low, higher low, and pause right in the middle of all that crap. Perfectly postured. So that's the longer term view, and it uses the same kinds of markers that we use when we're doing the market health check. So I now ask you to put together your trading plan. Now, if you put together a trading plan, this is part 2. If you haven't put a trading plan together, then this is what part 2 will be after you go through that. This is a very powerful exercise. It's a power multiplier. It's a turbo boost to your brain. I'm going to leave it up to you right now that if you haven't done the trading case and you want to take on part 2 fresh, you should turn this off now and then listen to it later. Or you could just suck it up and listen to where it's going and then go ahead and do your trading plan. That'll be fine. It's probably worth it just to hear this. So Eugene, awesome, put together a very nice trading plan. That's published on the Patreon site already. Very nice work. Now this is the high payoff assignment 2. This is reflective learning and metacognition. So now we're going to go through a process of second loop of learning or double loop learning to see what emerges when you reflect on your trading process. What I want you to do is take a blank sheet of paper and a pencil, and I actually want you to do that right now, because as I go through this, there's going to be some things that just get your attention and make you go, ah. Make a note of those. Draw sketches if you have to. And then make a note to yourself to come back and think about what it means. Just trust your note taker right now that if you notice yourself going, aha, that means you should come back and think about that more, because it means something special to you. We don't have to figure out what that is right now, but you want to make sure that you don't lose that moment. Okay? I want you to trust your note taker to make a note, and I want you to trust the insight maker found something that you should study. So if you have an aha moment or a surprise, make a note to think about it later. I want you to notice all of the words that I've bolded. Those have extra special meaning. So I'm just going to read through this, and I want you to use your eyes to see the bold words and your ears to hear my emphasis, and trust your hand to write the things that make notes and make notes of it, and come back to it. So take a blank sheet of paper and pencil to make notes and sketches as they emerge. Trust the insight and make a note to think about it later. In the same way that you analyze the elements of the trade in phase 1, where you properly used specific tools, indicators, and perspectives to evaluate a particular trade frame, and then applied a standard process to integrate concepts into a narrative, notice that your narrative leads you. Your narrative leads you to make a judgment about action, And then you rehearsed, refined, and reviewed your plan, like you always do. And you prepared and resourced your plan. That's what you do all the time, routinely. So, I want you to take that plan that you just put together and just set it down for a moment. Just set it down for a moment. I want you to breathe and stretch and just let it go. Breathe and stretch and just let it go. Now that you took a quick break, to reset in your zero state, you took a quick break to reset in your zero state. Now, so refreshed. Just enjoy that simple pleasure. It's profound. Breathe and stretch and just let it go. Take a quick break and reset in your zero state. Now, so refreshed. Just enjoy that simple pleasure. It's profound. And return with fresh eyes. Look at your plan from a distance and see how it sparkles when you look at it from one angle, the angle you had when you put it together. Look how the light catches it just so. It's breathtaking. Now, walk around your plan, gently observe it, and see what you may see. For Luke, go walk about. Walk around your plan and gently observe to see what you may see. Go walk about. Every time you see those three dots, that's a deep breath and release. And enjoy that feeling. That's resetting in the zero state. Now you're refreshed with every breath. Now, you and your trusted friend and partner is walking with you. Your partner and friend is walking with you, and he's commenting to you as you walk together. Listen in. What are we hearing and feeling and seeing and sensing and saying about it all? Hearing, feeling, seeing, sensing, and saying. Those modes of learning. And we're going to be top down, bottoms up, inside out, and all around. What do you notice now? Again, your trusted partner and friend is walking with you and commenting as you walk together. Listen, what are we hearing, feeling, seeing, sensing, and saying about it all? From the top down, bottoms up, inside out, and all around. And what do you notice now? Breathe. A bunch of other people are coming. Now imagine a skeptic is joining you, and now you wonder what they might say with their gift of different insights. A skeptic. And now a critic who joins you to find faults and smugly say, you see, I knew it. Breathe. Here's what I want you to do with a critic. Give thanks for critics who have such powerful lights and penetrating glances. They see everything and they know it all so that we don't have to. And they go out of their way to share it with us. Amazing. Such gratitude. They make us stronger with their gift of their truth, no matter where it comes from or why they use it. Hey, that's their deal, not yours. We don't even have to ask. They just give us that gift for free. Amazing. Thank you, critics. You play a role for me that I could never do for myself. Without you, I am incomplete. So thank you, critic, for any reason. I have my reasons to thank you. Amazing. Reframe criticism and what it means. One more data point. Now, deep breathe twice, 6 dots. Laugh a lot at this wonderful cast and crew who are supporting us on our journey to the West. Google that and appreciate that story. Now, your job, professional. Use craft and care to finish the plan with careful packaging. It's ready to ship. Use craft and care to finish the plan with careful packaging. It's ready to ship. And we're going to give that gift to our trusting trader who's going to enter that trade carefree and unaware of the safety that you built into the plan. They don't know it's there, but it's there for their own good and long-term sustainment. This is so important. The guy who pulls the trigger is our trusting trader. You're here to support that guy or gal. So use craft and care to finish the plan with careful packaging. It's ready to ship. Give that to our trusting trader so he can enter the trade carefree and unaware of the safety that you built into the plan. But it's there for their own good and the long-term sustainment. Remember, insurance is for rainy days, and rainy days are always coming, and it's raining somewhere right now. In fact, it might even be raining here or in the next few minutes. If you don't read that every day, I don't know what's wrong. I can't help you. Yes, I can. Read that every day. Use craft and care to finish the plan with careful packaging. It's ready to ship. And give that to our trusting trader to enter the trade carefree and unaware of the safety that you built into the plan. But it's there for their own good and long-term sustainment. Insurance is for rainy days, and rainy days are always coming, and it's raining somewhere right now. And in fact, it might even be raining here or in the next few minutes, so pay attention. Now, breathe. Feel the rush as the pace quickens. So here we go. Buckle up. That trader has entered the trade, did their job, they go take a break. Our fireman is going to take over and get our risk out of the trade. Our fireman gets our risk out of the trade. Our manager is going to get us to a good result. The fireman gets us to no lose plus dinner for 2. That gets our risk out of the trade. And then our manager takes over so the fireman can go rest and go reset in the 0 state. How refreshing. Ready for the next one. Meanwhile, our manager is going to get us to a good result, an average trade. And our expert is going to come over and then take over and get the most from a great result. And our caretaker is going to take care to finish the trade properly to our battle drill and carefully and quietly put it to rest so that we can reset to get ready immediately for the next trade. And then the team comes in. Our accountant's going to tabulate, our scholar's going to analyze, our artist will imagine how it might look in the future, our designer is going to illustrate the possibilities, our draftsman is going to structure the frame, our craftsman is going to build that safe scaffolding, our inspector is going to certify the trade. Our scouts are out there right now looking for new signs. Don't worry. Our tinker will work on new ideas and prototypes in the workshop, in the Gemba. And our Gemba, the workshop, is bursting with ideas. Don't worry. More's coming. Infinite opportunities. Relax. Our tester is going to try on those tinkers and just try them on for size and see how it fits. Our student is going to safely and quickly learn the skills and try them on in practice. Our guides are going to help us show the promising ways. Our note taker is going to take all the notes. Our chief of staff is going to run this business, and our leader is going to point the way and take the first step. Breathe. Our tribe shall prosper for the good of the people. All those guys are in the tribe. Our tribe will prosper for the good of the people. So all you got to do is this. Pick up what you can handle, carry what you can lift, keep taking steps, marching forward, onward, forward, upward, relentlessly, patiently, one step after the other, with care and compassion and determination and charity to all, in a world with tigers and sharks and herd animals. We are going to prosper in the tribe. And it's a cycle of life around the great karmic wheel on the back of a tortoise, and it's turtles all the way down. So enjoy. So that script is how you get through this. Okay? Now, back to work, students. So what we're going to do is we're going to apply these standard practices that we've just been through to understand, visualize, and describe your own planning process so that you can direct, lead, and assess that SPCE trade for Monday. And then once you do that, you'll be ready to lather, rinse, repeat for Monday, for Tuesday, for every other day. It's all the same day, man. It's all the same day. That's what Janis Joplin said in her interview with Dick Cavett. Look that up sometime. It's all the same day, man. And it really is. Today and tomorrow. In addition to SPCE, think about picking one more symbol, like a frog champion out of DIA, the Dow 30, Mexico, Brazil, Russell Small Caps, or Wheaton, and they're frog champions, and apply the same technique every day this week. That's the process of adaptive hybrid trading. This is metacognition. This was plan, prepare, execute, and assess. This was the planning and prepare, which is part of the understand, visualize, and describe. Monday is direct, lead, and assess. Then, in greater brackets, we're going to assess that whole process. So that's metacognition. Now, here's what I want you to do. Take your blank piece of paper that you've been working through now or later when you do this again, and notice what you wrote, and now notice your feelings and your thoughts. Notice them now, and then notice them when you look at that set of paper markings, because those are all triggers to the emotions that you're feeling right now. I want you to think about transcribing your experience from that scribble sheet into the modified Cornell note sheet system for structured learning. Use the 4-column learning journal to lock in the learning with good notes. Make a learning journal entry about your experience through this. Share it with your accountability partner. Send me a copy if you feel so inclined. And now draw a picture of your ecosystem. You've seen mine. What's it look like for you? Here's what I want you to recognize. That what you did is that I'm teaching you how to use a standard set of indicators, boxes, tools, and techniques on how to structure a trade. And I'm teaching you how to go through a systematic process to do that. And what we just did in this exercise was the same thing, only instead of analyzing an external trade, we're analyzing your internal trading process. The way your mind works to gather information, look for opportunities and problems, structure action plans, put it together, and then resource it, and all that stuff. Everything that was in that text, everything in the script are the ways that you go through that. Every one of those is part of a structured approach. That whole thing is a way to structure internal process. That's my internal process for how I think about every trade frame inside the larger ecosystem of my mind, body, spirit, and world, and who I'm working for, my family and tribe, in a world of herd animals and tigers and sharks. And it's tough, but we're survivors. Okay? That should move mountains for you guys, or I don't know anything. There's maybe some deep fundamental shifts buried all the way down there into the roots of who you are and where you're going and what you're doing. And so this is just one way to reach down in there and unpack it and look at it and pull it out. And now when you go look at my little mind maps and charts on that mind map that I use to go from the close of the day to ready to trade, that's where that comes from. Going through this, and then that is my step-by-step procedure, and that's what I do. And then the 2-hour battle drill is actually how that's what my character does. I want you to just think, I'm going to hit some highlights on this while I got you, exhausted. When I go through all these little pieces, that little trader, all he's got to do for me is pull the trigger and get in. Everything I did in planning and prep put him in a safe spot. He can't screw that up because I've already built in all the safety. He can't hurt the team. All he's got to do is take the shot. Take the shot. If he can take the shot, maybe he can be a sniper and an expert later. All he's got to do is take the shot and then go take a break. My fireman is the guy who gets us from the initial risk to the no lose plus dinner for two. Once I'm at no lose plus dinner for two, my fireman has done the job. That's why he's my hero, and he goes back and rests. Then I just hand it to a manager. Get me from no lose plus dinner for two to an average trade or exit. Once you get above an average trade, call the expert, my sniper. Now, sniper, we got something here. It's already an above average trade. Now I sharpen my knives. Here we go. I'm going to get the most out of this trade. So when I'm doing span of control, this is one of those where I clear the deck and I get 2 or 3 bullets into it, and I'm working the dog shit out of this one. Pardon my language. This is where my expert rolls up his sleeves and gets the most from a great result. And then when that is done, and it feels like it's starting to stall, done, give it to my caretaker, 2-hour battle drill. Take care to finish this trade properly and carefully and put it to bed so that all these other guys can go reset and get ready immediately for the next trade. Meanwhile, all these other guys come in and do their thing. Those are all the guys that are handling the plan, prepare, and assessment. What I just talked about there, those were the executors. The trader, the fireman, the manager, the expert, and the caretaker. Those 5 guys handle execution. Everybody else is helping. Remember, the last thing that you do before you hand this off, remember the designer sketched it out according to the template, a draftsman structured it, a craftsman built it, an inspector certifies the trade. Those are the guys who prepare it. Those are the guys who hand that trader, that young naive kid, they give him the bulletproof insurance safe trade. Meanwhile, wider view planning, scouts are out there looking for other signs and market turns and all that other stuff. Pardon me. And then this is just me noodling around. When you see me noodling around with different ideas and whatever, that's the tinker. I love that guy. My favorite guy. Just tinkering on new ideas and prototypes in the workshop. That's the place of respect. And now our Gemba, our workshop, is loaded with things. There's more things than we can possibly do. Go look at that damn daily report. Pardon my language. That daily report is the Gemba. That's all the raw materials and finished products and components for you to build and assemble your prototypes and test it out and make this stuff your own. You have all the raw materials and components ready to assemble, like Legos or Tinker Toys or Erector set, whatever it is. So just try it out. Test it. Try them on for size. This is you. You've got a Gemba that's bursting with ideas. Have your tester try it on for size. Then be a student for the ones that feel right. You pick it, your pace. Learn at your speed. You don't have to wait for anybody. You don't have to slow down for anybody. Just move out at your pace and learn and use the learning ecosystem. If you got an accountability partner or people with similar tastes and you want to get together, that's easy. And then all of us are each other's guides because we're all acting as skeptics and critics and supporters and partners and all that stuff. Trust your note taker to take the notes and your chief of staff to run the business. It's a business of staying alive and thriving. And then you are the leader who points the way for you and takes responsibility and takes the first step and then the next step. Some people say taking the first step is hard, the hardest step. I think it's the second step. The first step, you got over it and you made the emotional breakthrough and you took that first step and it's, oh, wow. The second step, you know something now. You know how hard that was. Taking that second step is hard. It's harder for me than the first step. And then every one after that is easier. Each trade that you make is easier. When you post a trade frame in the chat room, the first one feels hard, and then you realize, yeah, I can do this. The second one, you learn so much from the feedback that you got on the first one that the second one is actually even harder because you'll raise your own standards. After the second one, they get easier. If you want to get better, post one trade frame a week in the chat room. Mark them up the same way that I mark them, or any way that makes sense to you. One trade frame a week, your best one. You'll get feedback. Your accountability partners will give you feedback. Other people will use your trade frames, and they'll give you feedback. And then take one trade that you closed, whether it's day trade or swing trade, and this paper trading first. When you close one trade, mark it up the way you see me marking up the feedback that I give when I'm coaching. Mark it up and post it. So if you want to get better, post 2 charts a week. One trade frame for plan and prepare, one trade frame for execute and assess. If you do that for 5 weeks, you are unstoppable. If you won't do that for 5 weeks, then you are not serious. And that's okay. But that's the speed run to excellence. I'll tell you, the best guy I ever grappled with in the dojo. He came in as a white belt, and he was an excellent wrestler, but he came in with a white belt. He went up to the black belts, one after another. I throw you, you throw me, and he just kept going. He did not care about getting thrown. He wanted to feel it and do it and learn it and just get to the next one. And he got to black belt faster than anybody I've ever seen because he just went in and grabbed it and go and learned from each iteration. He came in prepared to learn. And he made the most out of every training opportunity by being a serious person and enjoying it. But he was serious about learning fast. And Musashi tells us, do not engage in useless activities. Everything you do is the way you are. And there's no difference between the way you fight for your life and the way you prepare to fight for your life. Otherwise, you don't understand what fighting for your life means. If you ever had to fight for your life and the lives of others, you know exactly what that means. Do not engage in useless activities. Train the way you're going to fight. Get the most out of every iteration. Make a commitment to posting one trade frame a week and one trade closure report a week. Not until you're ready to do it, But when you're ready, you'll know when you're ready. When you feel like you should probably do it. When you feel like you're 80% ready, just go for it, dude. Ship it at version 0.8. And then you'll get the feedback, and that'll become version 1.0. And then the second one, it'll be version 2.0. And then off you go. You'll be unstoppable. That's my guidance to you. That's my best recommendation. Okay? So pardon me for the some of the typos. I'll clean all that stuff up. What I will probably do is do another recording of that. So it's just the script. But I'll tell you, if you clean up the script and adjust it the way you want, and then read it into a microphone with conviction in your own voice, you will be unstoppable. And then add to the guys in the business there, the people that you identify that are on your team. I want to share, the last thing I want to share with you is from Joe. This, by the way, is that modified Cornell note-taking sheet. So you can download that from Patreon or in the chat room or in the hybrid workshop, or send me an email. Take your notes and your scribbles and then use that structured approach to put the prep material at the top, keywords on the left, notes and sketches and whatnot in the middle, aha moments and synthesis on the bottom, any notes to yourself, systems and markets that fall into those categories, and then a commitment to action on that side. If you do that, you'll be amazed. And if you do that, it might look like this. Just a moment. I thought I had some samples. So I've got some of the guys going through the boot camp and all the courses in the hybrid workshop, and they're listening to each video, and they are building out a note sheet. And this is an example of one of them. So Victor put together for video number 101 or 002, and he put together this was a video about me and how I coach, and some notes that really reflected to him, and it was awesome. And then he did, let's see, let me find one. Here's Antonio. Let's see. Stand by. Dagnabbit. So I've got the guys going through all those videos, and they're putting together one page for each video, and we're going to assemble that into a structured syllabus for each course, and you can use that to compare to your notes, and you're going to be amazed to see what other people find amazing. And I gotta find Joe's comment. So Joe did an approach like this. Man. So he says, Ken, I've teamed up with 4 traders, 3 from your group and 1 from another group. We have weekly calls, share charts and ideas. And as I get questions, I reflect and respond and learn a ton. And here's how I answered one trader today who asked, hey, how can I control anxiety while in a trade? And so this is what Joe does. I divide into trading parts and categories, and the goal is to make all my decisions from a zero state. And having these different parts has helped me to do this. And now I can be in different parts in different trades without crossing the wires. So look at I gave you the guys I gave. Here's how he named them because it resonates with him as a businessman. For him, the CEO's job is to manage risk, make sure I survive, and how much I'm risking per trade. For Joe, the stalker scans charts, finds opportunities. How far can it go? Will I stop and reverse? The striker presses the button. That's the guy that enters and then gets out of the way. The observer, all he's got to do is nothing to do. It's moving in my favor and then stop because of reasons. So he's just managing the trailing stop. And then the cowboy trader is what he does. Once it gets anything better than the trailing stop for Joe is a cowboy. And anything he's going to get is only going to be more than what the observer got. So the observer is his trailing stop, and his cowboy is only allowed to exit higher than the observer. So now he gets to enjoy the fun of the win, and the observer makes sure that all he's got to do is don't screw it up and keep the cowboy north of the trade and north of that exit. And so he's got a very clean set of parts, and those visualizations, which are anchored in his feelings and anchored deep in his identity as a businessman and probably a cowboy. Here's what happens. See if you can think of in terms something like this. Anxiety levels will go down. Decisions are made more consistently from the zero state. And most importantly, profits go up. So that's how Joe took that same lesson that we just did and turned it into an elegant, personalized, appropriate battle drill that has cleaned up all his anxiety in trading. I think, let's see, I think he uses the observer for that because he uses I think he's just using the trailing stop. I don't know if he's accelerating the move to no lose plus dinner for two. I usually don't get there as a result of a trailing stop unless it was just amazing. So I'm going to talk to him about that, and he's probably listening right now. So I trust his judgment on to use it or not. But you get to enlist, you get to hire all the guys that you want. Like you could add more guys or less guys than I do or whatever. Your call. So that's what I want to say about this exercise. So the deceptively simple one was the idea of the SPCE trading case, right? The second round is that we're using the same kind of structured processes and concepts to examine our own thinking processes. And we're going to analyze and manage that the same way we analyze and manage trades. Only we have become our own object of study and management. So that's the point that I want to make on there. The same level of systematic, structured process and continuous improvement works not just for finding and managing trades, but for finding yourself and managing yourself. So that's what I want to say about today. So thanks for hanging in there, guys. This was a long one, but Saturday night, what were you going to do? Go through all that stuff. Happy to read anything you send me. If you haven't done the SPCE and want to get to it, go for it. I'll talk about some of the technical pieces of that tomorrow. But today was some heavy lifting. You dug deep and you filled up bags full of dirt and carried those heavy bags to the surface. And now your job is to wash away the dirt and find and keep the gold and the silver and the other precious metals. Okay? So take good care, and we'll see you tomorrow.